Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Having a balanced approach towards portfolio construction is very important for securing sustainable returns. There are economically highly sensitive sectors, then there is economically low sensitive sectors. Solitaire, our multi-cap product, has balanced its exposure to dodge the swings of the economy. Join us this coming Saturday to take the walk down the memory lane and celebrate 4 years of Solitaire.
Friends, in this video of ithought Advisor, I am talking to you on the topic why asset allocation is Mr. Dependable. If you see the portfolio of Berkshire Hathaway, you will see lot of cash on their books, billions of dollars lying in short-term instruments. And then when you see a crisis like the 2009 problem, you will see that they would have deployed a lot of money in a short burst of time. So, they are able to buy the best businesses at valuations which are favorable to them simply because they are keeping a lot of cash. The success comes from how cash plays an important part in their asset allocation. All of us see only the success on the equity side, but the cash which they hold is what helps them to do it so successfully. And they buy the best businesses. They don't go and buy mediocre businesses or don't buy things which are cheap for the sake of buying them. They buy the best businesses when such extreme valuations prevail. Over the next few years, we could see that happen again, and it would be a master class in how asset allocation can be a huge instrument in buying businesses at extremely attractive valuations. Yet, most of our investors don't rely adequately on asset allocation. I see a lot of people today invested in the riskiest part of the market and actually over invested. They also want to put all the incremental money also into the riskiest part of the market. What do I call as the riskiest part of the market? That part of the market which shows highest returns in recent years. Probably, if you are going to use asset allocation, you would take a little money out of that asset class and put it in a safer asset class. Maybe short-term funds, maybe gold. You will put it somewhere safer. But people want to invest only in the riskiest part. Now, this runs completely contrary to what Berkshire does. Now, clearly, this shows to us that the contrast between what a retail investor does and what such an iconic investor does is too stark. The retail investor who needs to believe in asset allocation doesn't believe in it, while the iconic investor who still has to generate some high returns on a very high base is actually using it so effectively. Clearly, asset allocation is a very dependable way. Asset allocation is Mr. Dependable for investors who have an appetite for high growth, who want to make better returns and who want to significantly outperform the market. That is the irony. If you want to outperform the market, you still need to use asset allocation. But in India, what our understanding is actually a muddled view. We are thinking that asset allocation is meant for us to not lose money, to make modest returns. Nothing can be farther than the truth. We are not applying asset allocation in a way in which we can make more money. If we decide to apply it in that way, then the rewards for moving capital from a higher risk part to a lower risk part in frothy markets should be higher. We are settling for lower returns. That is what the asset allocation strategies of the recent years have managed to convince investors about. Is this a sensible conviction for the long term? I think not. That is how I view this, because I see potential to make higher returns by using asset allocation than what asset allocation as a strategy is making today. The strategy's argument is that this is what most investors will be comfortable making, this is enough for them. So, if you are one of those investors who wants to make better returns than that, you need to think of better strategies. But one thing is certain, asset allocation clearly is Mr. Dependable. It is a fail-safe way and a repetitive model and a very sure shot approach through which you can move capital to safety when it is absolutely necessary to be done, and it is also a sure shot way and a very convincing way to move capital back to risk from safety when it is the right time. Both these things can happen only if you are a staunch believer in asset allocation, only if you realize how asset allocation is Mr. Dependable and decide to use it in your favor. Who is this meant for? It is meant for every type of investor. A very small investor, a family, somebody managing family wealth, somebody preparing for retirement, somebody who wants higher growth through equities, somebody who is running a family office. It is applicable to all of us. We need to believe more in it and we need to apply it in a new way. A whole new way is what asset allocation now badly needs, and if we find that way in our investing, we are definitely going to a better place, and most importantly, we are going to realize how much asset allocation is Mr. Dependable. Thank you for watching this video.